Hello, everybody. My name is Maurice Button, and I'd like to welcome you to the next in our series of speaker interviews. It's a great pleasure today to have Mathew McDermott, who's Global Head of Digital Assets at Goldman Sachs, with us. Mathew, welcome.
Thank you very much for having me.
Let's turn to the questions. Obviously, one reads some very sort of negative comments in the press currently about the state of the digital asset market. But what's really going on? What are the macro factors that are affecting it at the current time?
Yeah, I mean, it's a really good question, and I'd probably say there's probably a couple of key factors. One, certainly when you start to think about liquidity and capital with potential Basel IV kind of meandering down the path, that's actually having an impact on banks today, and people are starting to see the cost rise. So when you start to think about the potential of the technology and how a lot of the market really are focused on how you can re-architect the financial plumbing, there is this kind of realization that the technology really will have an impact in a very positive way. So the macro backdrop, whilst obviously kind of unpleasant for some in terms of raising rates, it is highlighting a real need where this technology can be hugely impactful. And as a byproduct of that, I have started to see across both the buy side, the sell side, and even the FMIs really recognizing that. And that's really kind of led to kind of a broad cross section of the market really focusing on a number of different projects in that space. The other point that I would probably make is on investment. I mean, we're all very well aware that there's been abundance of cheap money that's flowed into digital assets globally. That naturally, as the cost of liquidity has increased, has reduced significantly. And so now really you're seeing a very kind of a much more laser focus on projects where there's real commerciality, which I think is a key point, scalability, and where kind of companies have got good management teams, or where people can really see that this is truly transformative to the market. So I think if you think about the macro backdrop today, there are kind of two key areas that I see that have been impacted. And while there's a bit of pain, I do think for the medium to long term in a positive way.
Do you think, just a supplementary question to that, do you think that the surge in AI, all things AI and AI startups and so on, at a time of limited investment funds available for new projects, do you think that perhaps has taken some of the funding away from digital assets?
I mean, naturally, yes, because digital assets 2.5, 3 years ago was, the kind of the shiny thing that everyone was super focused on, a lot of money flowing there. AI obviously has got huge potential, and actually, interestingly, is following a similar pathway to digital assets. Obviously, the regulators are looking at the impact, and so it's kind of the playbook's quite similar. But so I think it really what it does, it kind of really then kind of emphasizes that the dollars that do flow into digital assets for the the projects and the reasons I mentioned earlier.
Yeah, so it's taking the froth away a little bit, which is perhaps
yeah.
And in terms of what you're doing at Goldman Sachs, which are the key areas that you see in terms of institutional adoption of digital assets?
Yeah, it's pretty broad. I mean, I guess just really kind of looking at our own kind of strategy. I mean, I think there are probably four core things. One, we are very focused on tokenization. This is something kind of our client base is, eager to push forward. And I think certainly on the issuer side, there is absolutely no shortage of opportunities. For us, it's kind of being judicious with the projects to make sure that, going back to that commercial theme, scalability, really building it out, and really looking to replicate what we do today in the kind of traditional markets on a distributed ledger. So tokenization, key focus. As a byproduct of that, that's why we've developed our own digital asset platform, so we can be more nimble. But really the focus there is broadening the kind of marketplace, bringing more people onto the platform, etc. The second key area, which we kind of touched on a little bit, is really kind of the collateral mobility. Really thinking about how you can more seamlessly move collateral around the marketplace, be that for intraday, repo, securities finance, and derivative collateralization. To me, that is going to have a profound impact. And the risk reductions, the operational efficiencies, the settlement efficiencies, all kind of very self-evident. But what we need to do is kind of scale that up. So again, real key focus, from our perspective, and I know many across the market. We also, as a function of having a crypto trading desk for cash settled options, futures, and derivatives, we continue to service that for our clients, see a lot of appetite, still in that space. Probably the trading activity is a little muted, but in terms of the appetite to onboard, so that's kind of, a focus for us, and building out the product suite there, again, driven by the clients. And then data and content, big focus for us. We do also have, as we talked a little bit about capital kind of deployment, we have invested, in a number of companies that kind of aid those kind of real core strategic objectives. So obviously a lot of time that we spend with those companies as well.
There's some very real opportunities there.
Absolutely.
For a moment, obviously the HM Treasury Asset Management Task Force is about to publish its blueprint for investment fund tokenization, and the LSEG is launching its blockchain-based trading platform. So where do you see the main benefits of tokenization and its applications in traditional financial markets?
Yeah, I think these have probably been, very well socialized at this stage, but I think there's probably kind of 3 or 4 kind of core benefits. I mean, one is, kind of enhanced functionality, which I think comes as a second order, and basically speed. And using the example of some of the transactions we've been involved in, that ability to settle, if that's what you want, T+0 to a given time, aids the precision in terms of your use of liquidity and capital. Operational efficiencies, you reduce fails, and just kind of improve that whole post-trade kind of reconciliation process. So there's a huge amount of value, there. I think the risk is a key thing, and from a regulatory perspective, safety and soundness of the market is obviously a big focus. And as you start to kind of create greater utility in certain asset classes that doesn't exist today, that ability to kind of allocate, that collateral mobility point assets on a T+0 basis, it really does enable the market to reduce some of the risk that kind of sits there today. So they're kind of like, 3 kind of real core areas.
Do you think it opens up the opportunity, with fractionalization of ownership for new products and new derivative products? Do you think that there is a whole new spectrum of opportunity there?
Yeah, I'd kind of flip it a little bit, actually. I would say that what it does do, it allows you, going back to the point about enhanced functionality, to kind of add, kind of new features to transactions. So, for example, if you're looking to do a digital green debt issuance, you can start to think about embedding KPIs and use of proceeds and things like that actually in the token. So there is greater transparency. In a world where, people are looking to go carbon neutral, that's very powerful. And one of the things that, a number of asset managers we talk to are focused on is that transparency. But then also, even thinking about some of the more traditional assets, and, there's a lot of discussion around tokenization of real world assets, that broadening of the investor base sounds, it's a very generic statement and used quite liberally, but the ability to kind of have funds which, say, today have a minimum denomination of $1 million for reasons of admin and operational efficiencies and the like, that ability to seamlessly reduce that, say, 50 or 100, just opens up to a new universe of private wealth clients, for example. It doesn't need to be necessarily consumer point in time. So that increased transparency, over time, and that's the key thing, as you kind of increase the adoption, should broaden the investor base and by, default, increase the liquidity. I do think you're right in the context of certain markets, you actually can create, kind of new opportunities. I think the tokenization of some fund types is a really good example of that, because fund units today are often non-transferable. So if you suddenly can transfer them, you suddenly can de facto create liquidity and then create greater use case for those. Similarly, thinking about the intraday liquidity, you can change the risk profile of that, and you can actually create a two-way market, which, from the discussions I've had across the buy and the sell side, will be very profound. And it's something that doesn't exist today because the settlement systems don't really allow that.
Yeah, I mean, it's a whole new world, isn't it, of opportunity. Yeah. What are the things that might hold back tokenization? Is regulation on a sound footing, and what about interoperability between different platforms?
Yeah, it's a good question, and actually there's a report that came out yesterday from Euroclear, Clearstream, and DTCC, and I think they kind of touched on some of these points. And while I feel that they're all positively moving in the right direction, there's still, kind of things that need to be navigated and, in a collaborative way. So yes, we are getting regulatory clarity. Anyone who's heard me talk will have said, 4 years ago there was nothing in terms of regulations. we've just seen a huge shift in terms of kind of where we are today. We've got the markets in crypto assets in the EU. There's many other jurisdictions that have obviously kind of moved very quickly, be it civil or common law. UK is moving forward, and so I think we're getting regulatory clarity, but there's still naturally more to do there. There is a focus on interoperability, and I think one of the things that I'm often asked is, do you create a number of islands and therefore kind of create inefficiencies even by using DLT, and which kind of just defeats the whole object of using the underlying technology. I think there's a big focus on that. So I'm kind of less concerned because I think that's something that's been addressed, and we use the DAML smart contract language ourselves, and there's kind of interoperability that we've kind of had with different platforms that's been relatively seamless, but still something that needs to be focused on. And then scalability, for me, the adoption scalability is the key thing. And that's where you want to start to see kind of two-way markets, the ability to make secondary markets and then kind of more seamlessly move collateral across the system. And that kind of feeds back into that regulatory clarity point.
Yeah, it's a fascinating new world, I think, the digitalization, well, the tokenization in particular. And we look forward to hearing much more about this at the conference. Sadly, we've run out of time on this interview today, but Mathew, thanks very much for sharing those insights with us.
My pleasure. Good talking.
Of course, these are many other issues related to tokenization will be discussed at the Tokenization and Digital Assets Leaders Summit at Guildhall in London on the 21st of May, which of course is being held as part of City Week. I very much hope that our viewers will be able to join us in person at that event.